Thanks everyone for joining us. I really appreciate it. I'd like to make this as interactive as possible, so feel free just to literally yell out a question because I can't see most of you. I can see some of you, or stand up and kind of wave your arms around. I'd be happy to stop at any point in time and answer any questions. So I want to make this as useful for you guys as possible. I was going to start off the session. I had toyed with doing this and with not doing this, but I think it might be fun. I had asked ChatGPT to write me a couple of jokes to warm up the crowd, and I think you should hear them, and you can understand some of the limitations of ChatGPT. Why did the AI mortgage broker cross the road? To get to the other side of the algorithm. But seriously, folks, the risks of AI in the mortgage industry are no laughing matter. Let's dive in. I did not write that last piece. That last piece was written also by ChatGPT. Here's the second one. Why did the robot mortgage underwriter get fired? Because it kept approving loans to fictional characters like Iron Man and Batman. But in all seriousness, and it actually wrote, but in all seriousness. So we can get right into this and kind of move along and see where we're at, what regulators are doing with AI right now. And as you can tell, it's wildly inconsistent from state to state. That is not going to change anytime in the near future. So we have to be very ready for a 50-state approach, unfortunately. We try to get away from that, but we've got to be ready for it. And really, there are some underlying things that we can do and to ensure that we are addressing what we need to address when it comes to risks. And we'll get into each one of those as we go forward. So the current U.S. bank regulatory guidance reflects a very broad and some targeted concerns. Obviously, we talked a little bit about yesterday, the June 6th from the CFPB and chatbots as it relates to banking relationships. We'll talk about that kind of more towards the end. It's interesting when you actually go in and dig in and read it. But really what we're looking at is, it's a new phenomenon. AI and AI-assisted lending, despite it being around for a couple years at this point in varying stages, it is a new phenomenon for regulators. It's a new phenomenon for lenders as well, too. And some lenders that are using it don't necessarily understand the product that they're using, which becomes difficult during examination times. So you've got regulators that are still trying to grapple with the new, unique risks and challenges that AI presents and that the usage of AI presents. So generally speaking, regulators have taken a very cautious approach. It's a very kind of wait-and-see approach to see what the impact of AI is ultimately going to be, what the potential adoption rate is from lender to lender, if the large lenders, large servicers, bankers, banks are using it, and to what extent they're using it. So the goal is the stated goal is to protect consumers from potential harm that AI can do. You may have also read, probably now, this is about a month and a half, 2 months back, the state of New York put out some guidance about using AI in decisioning as it relates to HR matters. So ensuring that employers are not going to arbitrarily use decisions that are made by an AI or by AI-assisted decision-making as it relates to employment decisions. Very interesting stuff again, but we're seeing really not a scattershot approach, but really a more targeted approach as it relates to things that are actually impacting the market and what may be impacting the employment market as well, too. Very interesting stuff to read. So the CFPB thus far has put out a little bit of guidance. They've put out guidance as it relates to alternative data and credit underwriting, alternative data including AI and machine learning. So what they're looking at is the potential for unlawful discrimination as it relates to the use of AI in that lending. And the biggest piece of this is they're urging and telling lenders and banks, all of that you need to be transparent in what you're doing. So the transparency piece, as you're going to see, is very much a through line in everything we're going to talk about today. It's one of those things that sounds wonderful, and we all try to be as transparent as possible, but the actual meaning of it has, in a regulatory sense, is important and impactful. So when we're talking about transparency, we're talking about the ability to explain why a decision was made, what the supporting reasons were behind it, and ultimately what the impact is to potentially your overall applicant pool. It's one of those things that it's not necessarily looked at on a single on a single case-by-case basis. They're looking for disparate impact, fair lending concerns, all of that, which we'll also kind of cover a little bit more later. There was a reiteration specifically about adverse action notices by the CFPB, and that is they need to apply equally, credit decisions need to apply equally regardless of the technology that's being used to make them. So in layman's terms, if an underwriter that is underwriting that on a manual basis would make a decision to decline that applicant, and the application is also declined by AI-assisted underwriting technology, you're fine. That's one of those things you can prove up, say here's what the actual details behind that decline was, here's how the AI, or here's how the algorithm got to it as well, so you can show that there wasn't going to be a potential different impact from the AI-assisted lending. A quick side note on AI-assisted decisioning and whatnot. I'm going to tell a story, a brief story. It's not mine. I was talking on a panel with the lawyer Tobias Moon, and we were talking about AI, and he mentioned a client of his, a bank, won't name them either, but mentioned a client of his where there were some concerns with a potential disparate impact concerning their AI assisted underwriting. And what had happened was, and this is interesting because this is where you can start to see the ghost in the machine kind of going wrong. So for a period of about 3 years, the underwriters and the underwriting management had noticed we're not doing any self-employed loans to plumbers. Oddly enough, they looked at all of these applications, and the consistency across these applications was the fact that they were not funding loans to plumbers. And it took a long time, but to get down to the bottom of it, they started looking at their servicing platform, which also was being learned from when they were using the AI-assisted underwriting. Meaning that let's see what the default rates are with certain borrowers, see what the default rates are for certain areas of the country, so on and so forth. Let's learn from that and help inform our underwriting. And they came to find out that there was one plumber 5 years ago at that point that had made a third payment default and didn't make any more payments after that. Ultimately, the house was foreclosed on. So the AI learning from that was plumbers are bad borrowers. Applicants that are plumbers should be considered potentially risky, and then that AI-related decisioning just deny loans to anyone that used the occupation of plumber on their application. So it wasn't necessarily a disparate impact, but did impact a very specific subset of applicants, so much so that the lender actually noticed this and needed to investigate it. So it's one of those things that you also have a significant amount of unintended consequences. That's where you also have to be careful. If you're going to put on and turn on learning from all aspects of your business in order to inform AI-assisted underwriting decisioning, you've got to be careful what information is being brought in, the weighting of that information as well too, and ultimately what transpires. You've got to go back and you've got to audit it, and we'll kind of talk a little bit about some of the risk mitigation that you can undertake in a couple minutes. So the main area of guidance that came out about AI actually came from the White House, from the Office of Science and Technology Policy, and it was a very broad thing. This is aspirational guidance. So obviously the White House wants to help influence where the prudential regulators are going, where state regulators are going as well too. But there is no rule-making authority inside of the Office of Science and Technology Policy. It's aspirational guidance, and that's what you guys need to take it for. But it's such that this is where our regulators are moving to at this point anyway. So very clear, need to take a lot of time to really understand what's in there if you are using AI. And so the OSTP released this guidance, this aspirational guidance, what they call the Blueprint AI Bill of Rights. It's a very high-level document that outlines a number of things that consumers should have as their rights when you have an AI-related decisioning, an AI-related servicing, any type of AI-related lending activity or whatnot. So that's where they're trying to come from. They're trying to show that they also, and we're not really certain whether or not this took place. I'd love to be able to talk to someone that actually was part of it, but they had said we engaged with subject matter experts, with industry luminaries, and we had these conversations. None of these conversations were public. None of these conversations were recorded. Can't find any notes of any of these conversations, but They do say that they happened. Again, if anyone knows anyone that was part of these conversations, I would love to talk to you and hear a little bit about them, because it's interesting what they actually come up with, because when you read the guidance itself, it doesn't read as though lenders had a lot of say in what it was. It doesn't read like a lender would like to read it and understand that rule that's applicable to them. So as we go through this Bill of Rights, there are a few subsections that are very important to it, that everyone, every consumer should have as their rights, is what the OSTP is. So the first one is safe and effective systems. So consumers should be protected from unsafe and ineffective systems. Now, there are no definitions of unsafe or ineffective, but from the contextual piece of the policy or of the guidance, we're led to believe that what that is really that there's no rampant potential misuse of AI in underwriting decisioning. So, like the plumber scenario, that's something that shouldn't happen. It's one of those things that you need to put protections in place to ensure that you're monitoring those and seeing whether or not there's a correlation between declines as it relates to obviously anything with a protected status or protected class, but also if there's some weird anomaly like denying a loan to plumbers. Algorithmic discrimination protection. That's exactly how it's written, and I'm reading this because it's important. It's part of the policy. Consumers should not face discrimination by algorithms, and systems should be used and designed in an equitable way. Again, obviously, we're not having any definitions of some of these things, but designed in an equitable way is really striking at the heart of fair lending concerns that the policy goes to. So ensuring that every single applicant is treated just like every other single applicant, and that no disparate impact ultimately occurs. Next is data privacy, and data privacy becomes its own kind of subset of these things as we're talking about them as well too. Ensuring that any data that's used is protected from abusive practices. So there's got to be built-in protections for the information that you use, or that lenders use, companies use in order to make that AI-assisted decision or the AI-assisted transaction. There has to be built-in protections that data isn't necessarily shared. We talked about this yesterday, talked about OpenAI and ChatGPT, and if you're putting sensitive information into those, which you shouldn't be, please understand you should not be, that those can be learned from, and you cannot guarantee where that information will go the second after you share it. So that's what they're talking about as it relates to that protection of potentially abusive practices for the data that you're using. And then notice and explanation. This is, again, one of those things about transparency. It's going to be in all of these things. So consumers should know that an automated system is being used and understand how and why it contributes to outcomes that impact them. The key part of that is why. You have to be able to explain why it's impacting them. So if there's a decision that's being made based upon potential alternative data that you're looking at, I know there are some consumer lenders out there that are getting additional information from Experian and Equifax, TransUnion, some like something that relates to postpaid cell phone plans. There's a lender that I'm aware of that uses the potential for a consumer to have a postpaid cell phone plan as a means to say that they are less of a credit risk because they were able to get a postpaid cell phone plan as opposed to using a prepaid cell phone plan. So that type of thing, if you're using that in underwriting, potentially as an additive approval, which I would recommend if you're using any type of alternative data, don't use it at all initially for declines. Use it only for additive approvals, at least until you understand what the impact is going to be and you have a satisfaction that you've got it under control. Use it for additive approvals. It gives you a much better story with regulators to say, I am using this information to be able to serve consumers in a more equitable way and be able to get consumers, potentially thin file consumers, access to credit that they otherwise wouldn't have. That's a much better story than I'm using whether or not someone has a postpaid cell phone plan to deny them access to a $2,000 line of credit. It's a much better story. So as it relates to state regulator activity, again, we're all over the place with state regulator activity. The only state that really came into its own and started to put out some guidance very, very early on is the state of New York. So you have the New York State Department of Financial Services. They issued guidance specifically on AI and machine learning in financial services. So this is where you would look to say, all right, where are other states going to move? We obviously look to California, we look to New York, we look to some of the potentially more progressive states, as for consumer protection at least, to see where other states in the country may move in terms of rulemaking. So what New York came back out and said, again, relating to transparency, the guidance requires that lenders have appropriate risk management processes in place. So policies and procedures that you put on a shelf is not adequate. Those are not adequate. You actually have to ensure that those policies and procedures that relate to protection of the consumer, so being able to explain a decision, why it's made, the sources that it is made from with the AI assistance, that type of transparency not only needs to be documented in your policies and procedures, but needs to be in action every single day. You can't just point to a wonderful thing on a shelf. We can certainly, a number of companies, a number of law firms can sell you a wonderful set of policies and procedures, but if your employees don't know them, if management doesn't instill the need to comply, the tone from the top is extremely important. We don't hear that a ton anymore, but it is. That tone from the top is extremely important as it relates to this type of compliance. So that is going to be important as it relates to AI and everything that you do. So the other thing, too, is that New York Department of Financial Services said these AI models need to be fair and unbiased, and that they're appropriately, again, transparent in the use of AI. So fair and unbiased is obviously the buzz term that we're going to use for fair lending. Are the decisions that are being made by these lenders using AI, are they good decisions? Are they decisions being made upon information you're allowed to make decisions upon? Or do you have that weird ghost in the machine as it relates to your plumber or to someone else, another type of employment, another type of profession that's being potentially targeted by that model, saying, all right, well, this person's a credit risk because they pay late. And at what point do you stop that is the other question. Do you say, all right, when you're learning, let me know as it relates to delinquency, how late they pay. Are they 30 days late? Are they 60 days late? Do they pay later in the month? And some lenders have gone so far as to inform their AI model on borrowers that make payments later in the month, particularly on simple interest loans where they're not actually bringing principal down at all. But that's one of those things that lenders are bringing into account, and it may not necessarily yield good results as it relates to decisioning. And it certainly is something that I would very much argue is suspect as it relates to transparency, because how do you explain that to a consumer? And that's one of the things that you've got to do in all of these instances is, I'm sure you do it on a daily basis, but put yourself in the shoes of the consumer, put yourself in the shoes of the applicant, try to understand what the decision is and how it was made, explain it as though you're explaining it to an unsophisticated borrower. There is the premise that you are talking to an unsophisticated borrower, potentially someone that goes and gets a loan, a 30-year mortgage. They've got that loan. They've got it once every 3 to 5 years. Maybe they did a refinance when rates were lower, but that's their only experience with lending. They have credit cards, sure, but that's a little bit more understood by them. They're not paying attention to the little pamphlet of terms and conditions. But with the mortgage loans, they understand what's going on. Obviously, you've got your consumer that is taking action in each step of the application, and then when we get to the decisioning, and we're trying to make an explanation as to why a decision was made, how do you answer that question? How do you explain to a consumer that over the course of 5 years, you had a model that was looking at the time of the month that individual borrowers that are similarly situated made their payments? It's difficult, if not impossible. You can certainly use it as a means to risk rate your portfolio, to say this group of loans may be a little riskier than others. You can look at it and say on a very macro level, I wouldn't necessarily use it on any type of individual level, on a very macro level, what pricing should be for specific loan products. If you're targeting specific loan products for a subset of individuals, one of the things that we've talked about a number of times over the course of the last 2 years actually is travel nurses. So travel nurses are very good borrowers. They pay very well. They're frequently, the issue that you have with travel nurses is a very lumpy income. They may work for 6 months of the year and receive a salary that's a six-figure salary that is easy to sustain them throughout the entirety of the year, service all of their debts, but they've got 6 months of the year where they don't have documented income because they're not working. Those contracts that they get are very lucrative. They work hard for that period of time. They decide they don't want to work for the rest of the year because they don't need to. So it's a very safe set of borrowers, but you've got a risky potential behavior as it relates to employment and to income consistency. So when you're looking at AI-assisted transactions, that could be something that you also program into your model, saying, all right, we understand that these subset of individuals, these travel nurses, they are well-performing borrowers. However, we need to discount the fact that they may have lumpy income. It may be that it's something where they don't have income for a period of 3 months or 6 months, whatever it is. But the income is still consistent. You can look over the course of the last 3 to 5 years. All of these things are things you can train a model to look at. They're all variables in your data that can be used to make decisions moving forward. But again, you have to be able to explain it. And if you have any difficulty in making that explanation, then you probably need to pump the brakes a little bit and figure out whether or not it's something you actually want to put into effect. Certainly would encourage you all to speak with your lawyers, speak with outside counsel before you put anything in on such a wide level that you have that trouble in transparency, you have that difficulty in explanation. Make certain that you're taking that extra step to really take a look at that. Do a risk assessment. Understand what the overall impact is going to be based upon your historical applications. Again, transparency as well as consistency here is the underlying message. So as we're relating to fair lending risks in AI, we've talked about it a little bit at this point, but we need to ensure that those AI-related decisions don't unintentionally result in unlawful discrimination against protected classes of consumers, because that can happen. Obviously, the plumber scenario is not necessarily relevant in this scenario, but if we had a larger employment that we said, all right, well, we don't like making loans to retail food workers. We don't like making loans to them, so we're going to put them on our riskier list. If you look at the jobs that retail service workers have, a significant amount of them come in at minimum wage and may be taken by protected classes. Could be potentially a lower socioeconomic class of individuals that might be made up of certain other protected classes, being minorities, being any number of things. You can also look at employment that is mainly taken up by either men or women as well too, to see whether or not you might be potentially discriminating on that basis, simply based upon what you've programmed your algorithm to say this is a risky line of work. All of those unintended consequences are extremely important, and I know you can't get to the point where you've looked at every edge case, every corner case, but you need to put the work in to understand what the risk is. And as long as you understand the risk and can explain what you're doing, you've got a very good standing with the regulators, especially in these next 2 to 3 years when there's still a lot of shifting as it relates to what regulators are thinking. So transparent and explainable, again, you have to have a transparent and explainable solution in your AI-assisted transactions. You need to be able to explain what you're doing, what the model is using to make those decisions or to influence the decisions that are made by it, and whether or not there's also human review. A lot of times these things can be completely mitigated by having I know we all want to be able to have a large number of transactions that may not necessarily be touched by a human, but this is one of those cases where if you make a declination decision based upon an AI-assisted reasoning, having a human review that, ensuring that, again, there's not that ghost in the machine, could be vital to your compliance and to ultimately the stance you take when the regulators come in and they're asking you why this occurred. So the other thing too is to routinely test these things. It's one of those scenarios where there are a number of amazing companies out there that can certainly assist you in quality control testing as it relates to AI-assisted transactions. You can do it internally as well. Take the time to do it. Ensure that you have a test plan as part of your audits, as part of your quality assurance. You have a test plan that takes a subsection of these applications that have been decisioned or partially decisioned by an AI-related or AI-assisted process. You need to take that step. It's something I cannot emphasize enough. I know it's expensive sometimes, or it can be expensive, but it doesn't necessarily have to be. It can be a point where you're looking at 3 to 5 different pieces of the transaction, 3 to 5 pieces of data, and seeing whether or not there may be a potential disparate impact down the road, seeing whether or not they're consistently applied across all of your applicants. That's the most important thing. And then as it relates to implementing these type of AI-related decisions, you've got to have an appropriate risk management function. You need to have a strong compliance department, or at least a strong compliance function. Some companies are small. They may not necessarily have the ability to have a standalone chief compliance officer, or chief enterprise risk officer, but that role cannot be ignored. You still need to have someone that can step in, has the relative independence necessary in order to serve in that function, and has the ability to speak to either the board or directly to the CEO, reporting very strong reporting line to be able to influence change at the enterprise. If you have your lead compliance, your lead risk person, reporting into your CFO or reporting into even someone down below the CFO on that line, that person arguably does not have the requisite independence and ability to speak to management of the entirety of the company and address the tone from the top that they otherwise would need in order to affect change. I mean, trust me, I've been in the role of a chief compliance officer. I know that honestly, compliance very much is a cost center, and we're not a revenue generator. Compliance isn't a revenue generator, but compliance can serve as a cost avoidance center for down the road when there are problems that would otherwise potentially be completely eliminated by having that strong compliance function, having someone that's watching your back to ensure that you're taking those appropriate transparent steps. It's vital. It really is. It's a cost that is well worth it in order to avoid potential future extreme costs as well. And then keep that maintained. Don't just simply again write a set of policies and procedures, stick it on a shelf, and say we've got it, we're good. Ensure that you're living that, or your employees are living that throughout the day. Regular training, all of the opportunities that you would otherwise give to employees, that they're up to date as to what is needed for compliance. It's important to keep that going. So the other thing that we can do is honestly listen to each other as well too. I mean, these type of conferences, this type of session is important. Share ideas. We're all in this together. As much as there may be competitors and everything else in the room, we need to ensure that we have the ability to speak transparently and effectively to the regulators about this, or else we're going to be legislated in a vacuum. If we don't make our voice known, we don't lobby, we don't mention our thoughts on AI-assisted transactions and whatnot, we're not going to have a say in the rules that are propagated against us. So we've got to take that extra step as well too. So talk with your colleagues, talk with other companies. Ensure you participate in lobbying days and in events like this. Make sure you have a voice in the political action of each one of these organizations as well too. It's important to take that step. I know that we only have about 1 minute and 12 seconds left. I'd love to answer any questions if you have them, or I can certainly answer them outside of this as well too. If you have very specific AI-related questions, we do have an excellent guest in the audience as well too from Theseus AI, Sam Elhaj, right there in the front row. Feel free to go up and talk to him as well too. You'll get it for free here, whereas if you call him on a normal workday, you won't. So ensure that any questions you have, we're happy to answer them. Is there anything right now, any questions right now I can answer? I don't see hands, so if you have a question, you have to kind of stand up and actually shout it out. If anyone's asking about the pocket square, because my son picked it out for me, it has a father and son dinosaur on it. So for Father's Day, I want to make sure that all the fathers out there know that that's what this is for. So have a great Father's Day weekend as well too for anyone of you that are fathers or not. Have a great weekend regardless. But if there are questions I can answer, please come see me afterwards. Happy to talk about it then or now. So thank you very much for taking the time to listen.